Hello everyone, welcome back to another video. If you are new to this channel, my name is Farhan and I help POA students like you ace their exams. Today we have got a past exam question from 2021 paper 1 and this is question number 3. In this question we will learn to identify the different types of errors which are involved and also how to correct these errors. This question also requires you to understand the effect on profit when the errors are not corrected. Lastly, we will also understand the accounting entity concept. You can see the question on the left hand side of your screen, and on the right hand side we have got all the workings which I'll explain and go through step by step. What I need you to do now is focus and follow through for an excellent understanding. With that being said, let's begin. Celine runs a beauty salon. When preparing the business financial statements for the year ended 30 April 2021, she discovered the following errors. So here you can see we have got 4 types of errors that we have identified, and the requirement in the first part of the question is to prepare the journal entry to correct error number 1. But what we're going to do is actually prepare the journal entries to correct all 4 errors, okay? So let's start with the first error. Equipment of $5,400 purchased on credit from Bernardo on 30 April 2021 had been recorded as $4,500. So this type of error is what we classify as an error of original entry. Error of original entry happens when the error is within the numbers. As you can see, the original purchase price for this equipment was $5,400, but we ended up recording it at $4,500. This means we ended up recording it at $900 less. Equipment in itself is a non-current asset because this is purchased mainly to help the business for generating revenue, right? Now that we have to increase the balance of this equipment asset account by $900, we have to debit equipment by $900 because when asset increases, we debit them. Simultaneously, we know we bought this equipment on credit from Bernardo, and Bernardo was paid Bernardo is supposed to be paid $5,400, but in our books we recorded the transaction at $4,500. Bernardo is a current liability for the business because we expect to pay Bernardo as soon as possible. So we originally ended up recording Bernardo at $4,500, but now we have to increase our obligation by $900 more. So we understand Bernardo is a liability, so when liabilities increase, we credit them. So we credit the account for Bernardo by writing other payables, specifically the account for Bernardo, by $900, which means liabilities are also increasing. Do not write trade payables here because trade payable refers to credit suppliers of the business. These are the people from whom you buy inventory on credit and then you sell the same inventory to your customers at a profit or at a markup. Here, you're buying a non-current asset on credit. So it's best for you to write other payables, Bernardo, to get full marks, okay? Let's look into the second error now. Depreciation expense on the equipment had been understated by $60. This is also an error of original entry because the mistake is within the numbers. So now what we have to do to correct this is to increase the depreciation expense first. When we increase an expense account, we always debit it. So we debit the depreciation of equipment, which is an expense account, by $60, which reflects an increase in expenses. Simultaneously, we credit a contra asset account. The contra asset account in this case is the accumulated depreciation of equipment account by $60. What do we understand by contra asset account? A contra asset account is an account which records the reduction for a relevant asset account. The relevant asset account in this case is the equipment. We understand equipment is a non-current asset account and we expect it to be used within the business for many years for the purpose of generating revenue. As the equipment gets used within the business, it will go through wear and tear and also therefore go through obsolescence, which means over time this equipment is going to lose its value. So all this value that this equipment is going to lose, we store it in a separate account, which is known as the accumulated depreciation account. And that accumulated depreciation account is a contra asset account in nature, which means when it increases, we credit it. So that is why we are crediting the accumulated depreciation of equipment account by $60. In fact, every time you've got depreciation expense that you want to record in your journal entries, you debit the depreciation expense account and you credit the accumulated depreciation account. Okay? Let's look into the third error. A credit purchase from Lucinda of $890 had been posted to the account of Belinda. So this type of error is what we classify as an error of commission, because the same category is involved but the wrong accounts have been used. What do we understand by same category? Both Lucinda and Belinda are credit suppliers of the business, which means they are in the same category of trade payables. Okay? So we made a purchase from Lucinda, but we ended up recording it in the account of Belinda. So as you can understand, wrong accounts have been involved, right? So how do we correct this? Originally, when we would have posted this credit purchase by mistake in the account of Belinda, we would have recognized a current liability or an obligation towards Belinda due to the fact that we would have thought that this was a credit purchase from Belinda. So we would have credited trade payables Belinda by $890, right? Now that we have figured out our mistake, we need to reduce that obligation first that we have previously recorded with Belinda. So previously, we showed that there is an increase in liabilities with Belinda when we would have credited the account of Belinda by $890. Now we are decreasing that obligation, so we are decreasing our liabilities, and when liabilities go down, we debit it. So we will debit the account of Belinda, trade payables, specifically the account of Belinda, by $890, and simultaneously, we will recognize the credit purchase that we have actually made from Lucinda, which is to increase the obligation we have got towards Lucinda, which means our liabilities are increasing towards Lucinda, and when liabilities increase, we credit it. So we will credit the account of Lucinda, trade payables, specifically the account of Lucinda, by $890. All right? Now let's look into the fourth error. Fuel for Celine's private vehicle of $75 had been recorded as motor vehicle expenses for the business. So here we have got a private expenditure of $75, which relates to petrol for Celine's car, but we ended up mistakenly classifying it as a business expense. So this is a violation of the accounting entity concept, which is also known as the business entity concept. And also at the same time, this is a violation of the error of principle because the wrong categories are involved where the private expenditure has been treated wrongly as a business expense. So how do we fix this? We understand that we wrongly recorded this private expenditure as a business motor vehicle expense. So we would have debited the motor vehicle expense by $75 as a mistake. Now we have to get rid of this mistake, which is to reduce this motor vehicle expense by $75. Expenses, when they increase, we debit them. But now that we have to reduce it to correct our mistake, we credit it. So we credit motor vehicles expense by $75, which means expenses are going down. Simultaneously, we would debit our drawings account by $75 because this $75 was taken from the business bank account to fund a private expenditure, which was wrongly recorded in the business bank account. So that is why it's always best to keep private and business bank accounts separate so that you don't end up making a mistake. So we debit the drawings account by $75 because it shows that Celine has taken some money from the business for private use. So that way the transactions are kept separate and we don't make any mistakes, okay? All right, so the next requirement in part B is to complete the table which we are given here to show the effect of errors 2, 3, and 4 on the profit before correction, all right? Before correction. Now, so profit, we know, can be determined by taking the net sales revenue and then subtracting the cost of goods sold and then subtracting all other expenses that follow, all right? So based on error number 2, let's look into error number 2. In error number 2, depreciation expense was understated by $60, right? This means expenses were understated by $60. Expenses and profit have an inverse relationship with each other. So expenses are understated by $60. This means that you would have made an error by overstating profit by $60, right? So for the second error, we will write $60 in the overstated column. that's to show that due to that error, the profit was wrongly overstated by $60. Excuse me. So what about error 3? In error 3, where the credit purchase from Lucinda was wrongly recorded in the account of Belinda, only liability accounts are affected because, as we understand, this is an error of commission where the error was done within the same category but in the wrong accounts. So the same category here that we were talking about is the category of trade payables or credit suppliers. So trade payables are liability accounts, right? Because these are the people from whom you buy inventory on credit. So what's happening here is that no expense account is affected, therefore profit cannot be affected at all. So since only liability accounts are affected, there cannot be any effect on profit. So the question requires us to place a tick if there is no effect, all right? So in the no effect column for error 3, we are placing a tick to show that only liability accounts were affected and profit had no effect therefore. So what about error number 4? Fuel for Celine's private vehicle, $75, had been recorded as motor vehicle expenses of the business. So we understand that we classified a private expenditure as a business expenditure, which ended up increasing our motor vehicle expenses by $75 as a mistake. So we understand expenses were overstated by $75 due to this mistake. And if expenses are overstated due to the inverse relationship, profit would have been understated by $75. So therefore, within this table for error number 4, we record $75 in the understated column. All right? The last question. Explain the accounting entity theory. What do we understand by the accounting entity theory? Accounting entity theory states that the business and its owners are separate legal entities, which means that private and business transactions cannot be mixed. Therefore, only transactions relevant to business activities are to be used in the preparation of the business financial statements. Okay? So this is a very important concept, as you could see in the violation based on transaction number 4, where the private expenditure of $75 was wrongly recorded as a business expense. So we do not want that to happen, and we do not want to record private expenses as part of our business financial statements. All right? So if you include these 2 lines here for accounting entity theory, you should get full marks in this question as well. All right. So that's it for today's lesson. You could check the other correction of error videos that I've got a playlist, and you would find many videos there. And if you found value in this content, make sure to drop a like and subscribe to this channel, and also share this channel with your friends. In the description, you will find a link to book a free Zoom call with me and discuss your coaching requirements so I can help you prepare for your exams that are coming very soon. With that being said, I'll conclude today's lesson, and I will see you in the next one.